Hey, thanks, Dave. Thanks, everyone, for tuning in this afternoon. If you're on the West Coast, um, good morning. We got a lot of good stuff to talk about here today. I will, as Dave said, the recording or the presentations will be recorded, so feel free to take notes, but we'll also have access to that afterwards. And I will do my best to keep an eye on the question window. So if you do have a question as we're going here, feel free to type it in the box, and then I'll try to answer those as we go, so you're not just waiting till the end. We're going to be talking about day trading, specifically the E-mini futures, and even more specifically, using 1-minute charts. That being said, everything that we're going to talk about here in the next 40 minutes or so can be applied to different markets, different time frames. If you trade stocks, if you trade forex, even currencies and or commodities rather. So lots of good pieces and good nuggets that we'll present today that you can apply to your own trading, whether you decide to trade in this way or just take a piece of like the trail stop approach and apply that to your trading. So as Dave said, my name is Tim Racette, and I blog over at EminiMind.com. So we're going to go over a couple of specifics here in today's presentation, getting down to the nuts and bolts of how I trade the E-mini futures. And what you're going to learn in the next 35, 40 minutes, we're going to go over three specific techniques, and we're going to look at the type of candle that is most likely to get momentum. And so you can use spotting those candles as a way to help identify good entry points. Or if you're in a trade, you can use the spotting of those candles to help determine where to get out. We're also going to look at what I call the high of low bar, low of high bar. If any of you are familiar with Al Brooks, he also uses a variation of the HLB, LHB, and we're going to look at a couple of trail stop techniques that, even if you don't day trade, these techniques work very, very well for swing trading, for longer term trading. And so a lot of times, the entry into a trade is not as critical as people might think. If you just sat me down at your computer and fired off a trade and said, okay, manage it, having an exit approach to reduce your risk while at the same time give you the highest chance of a positive outcome, having that laid out is just as important as knowing where your stop is going to be before you get in the trade. So we'll talk about those trail stop techniques as well. And the kind of the goal behind trading, or this style of trading where you're looking at the first couple hours of the morning each day and then kind of calling it quits, is to kind of build that flexibility and financial freedom. In the morning, at the NYSE open, so the US Eastern time morning, that's where you're going to have the most volume, the most activity. You've got the European session still open and the NYSE US session opening. And so you've got that overlap in the first couple hours of the day. So, if you look at the Globex 24 hours of data, you basically have really teeny tiny volume bars all through the overnight session, and then bam, at the open of the 9:30 Eastern time, that's when all the real trading activity occurs. Then you get kind of a lull in the middle of the day, picks up at the NYSE close, and then just completely dies off again at the overnight. There's a little blip at the European Open, but that US Open is going to be your best opportunity to get moves, have the market, trending, or having the most likelihood of good trade opportunities. The close would be the second best time, but there can be a lot of whipsaw that occurs at the close. And so sometimes great setups just don't pan out because you have bigger institutions coming in managing positions not necessarily based on the technicals, whereas you have a lot more day trading and technical trading right at the open. So building a flexible, kind of financially free life allows you to spend time doing what you like doing, whether it's golfing or, for me, you know, riding my bike, spending time with my daughter, maybe you have grandkids, whatever it is that you like to do. If you can be very focused in that first 90 minutes, 2 hours of the day, then you can have the rest of the day to, you know, do what it is that you like to do. If you do work and you're on, you know, kind of a Pacific or Mountain time zone, you probably have the opportunity to trade before you go into work, and that's a great pairing. Or if you have a little more flexibility in your job, maybe you work from home, you can trade for a couple hours and then go, you know, you're already at the office. So if you sit there all day, when I first started, I did kind of trade the whole day. I would even wake up at the European Open and trade. And, you know, that's just not really sustainable in the long run, to sleep for a few hours, wake up, go back to sleep, wake up for the NYSE Open. And so sometimes during the middle of the day, you probably notice you get a little bored, maybe you make some mistakes or some boredom trades, and it's much more net profitable for me to be super focused first 90 minutes of the day and then be done. And as you probably noticed, a lot of your light bulb moments, or when things click, or when you have an idea, you know, those come when the markets are closed or when you're not in front of the trading screen. And so you could be stuck on something and you're thinking about it and you're looking at the charts and going through your trade log and your data, and you're just knocking your head on the wall. Then you go for a walk or a run or you know, pickleball or whatever it is that you like to do, and then bam, it just hits you and something connects and a light bulb goes off. And so getting away from the screen and specifically getting outdoors is really, really helpful. That's been a huge part of, you know, just furthering my success over the years. So whether you're part-time or full-time, you can trade kind of with a part-time, almost a part-time mindset, and you can generate full-time income even with, you know, 6, 8, 10 contracts. You don't need to be trading 20 or 30 contracts. You certainly can, but even with, you know, 4 contracts, you can take a lot out of the markets with not necessarily having to catch giant moves. So for those that aren't familiar with myself, as I said earlier, my name's Tim Racette, and I've blogged over at EminiMind for, I think, 2011. I started, I guess it's a website, but started as a blog, and where I just shared my ideas, and then people started commenting, asking other questions about my trading. I really started it so that I could access my kind of notes or thoughts from anywhere as I would be traveling, and then it just kind of turned into what it is today, just by folks asking questions. Hey, can you do a video on this? Can you show me this? And it just kind of gained traction. And it's not super huge. We don't have a huge team around us, but it's you know, developed into the website that you see now. So I've been trading since about 2006. I did a little swing trading before that, and kind of got into trading, day trading from the swing trading side. Now I primarily day trade the futures, and even more specifically the ES. And I do swing trade a little bit, do a little bit with options, nothing too fancy, mostly directional stuff actually, which, you know, it's much more popular to have advanced option strategies and, you know, butterflies and this and that, but do a little bit of swing trading, but mostly day trade the ES is my primary focus for the last, I don't know, 10 or 12 years. Outside of, you know, these presentations, I know I've met a handful of you at the Traders Expos and money shows, done some presentations in person at the Chicago Mercantile Exchange. That's actually where I'm from, is the Chicago area. And then I moved out I'm out in Scottsdale. Been out here went to ASU for my schooling, and then just kind of stayed for the most part. Came out here in the winter and then moved out here full time shortly after that. So outside of trading, I spent a lot of time outdoors, mountain biking, exploring, hiking, that kind of stuff. Spend my summers up in the Black Hills in South Dakota, up in that region. And so spend a lot of time outdoors, and that really helps to just kind of rejuvenate or center my focus so that, you know, in the morning, wake up, market opens, I can be super laser focused, and then know that, okay, after, 90 minutes, I can shut down, get away from the screen, and kind of you have that structure built in, almost like a, if you think about the typical NFL player or professional sports, you've got seasons, and then within the season you have games where you need to be super focused and kind of locked in, and then you also have rest and recovery days. You have scheduled breaks throughout the season. You got bye weeks. You got times where you're doing a double header, and you got to be really focused for 3, 4, 5 games, and then you get a break. And so having those breaks planned into your trading is also really helpful. And I know some of these little, I guess, sidebar items might not seem very important, but if you can schedule breaks throughout the year, if you're trading futures, rollover week is a good week to kind of pull back and maybe either take the whole week off, or certainly take expiration. I take that day off. I take the Fed meeting Wednesday, the meeting announcement Wednesdays off. That's every 6 weeks. You got a few holidays in there, but when you kind of plan those breaks, that can help the longevity of your trading. And so, starting from the big picture, as we, are about to get into more the nuts and bolts, can kind of help set you up for success, and kind of getting your finances in order. Maybe you're retired, and so, you've got a pension or a 401k, and you've got this, trading account that you're kind of using for supplemental income, and, having some of that stuff in order really takes some of the clutter out of your brain and kind of gets it either put on paper and organized in a way where it's not just taking space up in your brain. Having your trading desk organized, having a routine to follow each morning. You wake up, you read the newspaper, or you have your coffee and you read, for 10 minutes, or you go do a little run or a workout. Then you sit down in front of your trading computer, and just kind of having some sort of routine to set you up each day is really, really helpful. So let's talk about the trading aspect and some of the nuts and bolts. The first thing is kind of my chart setup. I don't have anything super fancy. I use Thinkorswim for my charts. You can use Ninja, TradeStation. It really doesn't matter. When we're looking at 1-minute candlestick charts, every platform is going to be set up with that. I do my trade execution on Tradeovate, which is also owned by Ninja now. Again, it doesn't really matter what platform, just keeping things as simple as possible. I have traded on Thinkorswim. I have all of my retirement and brokerage accounts at Thinkorswim, but the intraday margin is quite high for TOS. And in the past, I've paired I've had one account, one brokerage account, and I would swing trade out of it and do my day trading in that account as well. And then that kind of helps piggyback your capital, because if you have $100,000 sitting in your account, and you're with futures, you're in and out so much that you can get by with a much smaller account, and the opportunity cost of that cash just sitting there not making any money does start to add up as you get into bigger and bigger numbers. So something to think about. Same with swing trading, just as a sidebar. Swing trading, you can make some really big percentage returns, but if you're only trading, let's say, if you're only risking 1% of your account and you make 80% on a trade, what is that net return as a relationship to the total account? And so if you get to the end of the year and you've only made 6 or 7% on the total capital that you have allocated towards that account, you would have been better off just stick it in a Vanguard S&P fund and walking away. So just some things to consider. With day trading, you can easily get away with starting with like a $5,000 account if you're trading the ES. I always suggest folks, now that there's the micros available, to first start on Sim if you're brand new. Get familiar with the platform, get familiar with the trade ladder, have your order brackets all set up and do all your practicing in the Sim environment. Do that for a week or two and be practicing one market, one time frame, one setup, so that you can, again, get locked in and just be looking at one market, one time frame, and one setup. Then as you start to, take some trades, you can move to the micros. And so you've got real money on the line, but it's really, you're hardly risking anything. And with that, you can open an account with a couple $100 with Tradeovate or some of these other discount brokers. It's $500 intraday margins for the ES. So you can get away with very little capital. And I used to be in the camp that I'd want to have like 10 grand per regular mini ES contract, but you just don't need that much. You'd be better off sticking 50 grand in a savings account, kind of allocating it towards your trading capital, but only having 5 grand in the actual account if you're trading 2 lots. And that way, if something happened and you lost internet connection, or for some reason the orders got stuck out there and your computer froze and the market sold off, your physical risk of money in the account is smaller. And that's why I separate my charts from my trading account. I used Infinity Futures for a long time. They've since gone away. And then the last, 5 or so years, I've used Tradeovate. And if for some reason Thinkorswim would lock up, then I've got Tradeovate, as a backup, and vice versa. So this is how I set up my chart. I've got kind of the main chart. I will typically have 2 charts on this screen. I've maximized the 1 minute chart because that's what we're going to be talking about here today. But this is really it. I have 2 monitors set up and the trade ladder on one screen with my Excel trade log, and then the actual chart and tickers on the other screen. So the first thing we're going to get into is the candlesticks, and what we're looking for is going to be hammers and inverted hammers. And specifically, as we go through the chart and look at trends, spotting swing highs and swing lows to identify the trend. So looking for hammers in the context of an uptrend, looking for swing highs and swing lows, like I said, to clearly identify we are in an uptrend. And we're going to kind of go fairly quickly into the intermediate and advanced concepts. And like I said, if you do have questions as we're going, feel free to drop them in the chat. But from a basic perspective, an uptrend is going to consist of higher highs and higher lows. So the time frame that we're looking at is the 1 minute chart, but this could just as easily be a 5 minute daily chart. I purposely cropped out the x-axis, so the concept is the same regardless of the time frame. But hammers in an uptrend and then inverted hammers in a downtrend. And what makes a hammer or an inverted hammer? Well, what we're looking for is a candlestick where the body, the filled or unfilled part, is about a third or less of the entire candle. So if it's a 3-point candle, we want the body to be about 1 point. When you have like this first arrow I've got on, that's a doji where the open and close are the same. That also constitutes, I would qualify that as a hammer setup. The candle right next to it would be a true hammer, but a doji like that is just fine as well. So hammers and inverted hammers are kind of the candles that we're going to start by isolating. And the reason that they're helpful is they signal price rejection. So if you think about it, like this inverted hammer here, at one point in this 1 minute time frame, it looked just like the candle before it, a big green bar, a big bullish candle. And then in order to form an inverted hammer, it would have to retrace, sell off, close somewhere near the open to form that inverted hammer shape. So price rallied in the case of an inverted hammer and then was rejected. Could be at a resistance level, could be at a prior high. It could be for a whole number of reasons, but whatever the case, by the time that 1 minute bar closed, price was rejected and now price was going down. So we'd be looking at shorting with that new fresh momentum to the downside. An inverted hammer would be just the opposite, going price is moving down for most of the candle, and then it rallies at the end, and that's what forms the hammer. So this concept of low of high bar, high of low bar is the idea that we're looking to get long above the high of the hammer. The hammer happens to be the lowest bar in the pullback. The tail of that candle is sticking down below the other bars. The market's moving up at higher highs and higher lows. It pulls back, forms that hammer candle. Price was rejected at lows, forms the hammer, and then we're getting in as that momentum is now returning to the upside. We know the trend is already up, and so we're getting in as the momentum is kind of going in our favor. And so that's the high price. We're buying one tick above highs, getting long above the high price of the lowest bar in the pullback, HLB. And then on the flip side, the low of high bar is simply upside down, the lowest price of the highest bar in the bounce. Hammers and inverted hammers are going to be the clearest and easiest ones to identify, signaling that price rejection as you develop as a trader. If you're using those as your entry signals, you can add in things like spinning tops, bullish and bearish engulfing candles. Those are also considered reversal bars. But the context of where these fall is also important. So high low bar, low high bar. The hammer in trend, hammer in an uptrend, inverted hammer in a downtrend, those are going to give you the best likelihood of trending. But we could also have counter trend that we'll get to here in just a couple minutes. So from an entry stop perspective, the initial stop for the ES I use is 3 points. And sometimes the candles are a little smaller than that. So you can put your stop, you can bring it up underneath the candle. If the candle's only 2 points big, one tick for entry, one tick for stop, you can tighten it to 2.5 points. So 3 point stop, 6 point target is going to be your simplest approach to getting some kind of base hits, having a 2-to-1 reward to risk initially, and then we're going to talk about how you can tighten your stop as the trade goes in your favor. And not every trade is going to be a 3 point loser. Not every trade is going to make it to 6 point either, but having that 2-to-1 as kind of your target point is a really good kind of easy base hit for the ES. So looking first at the trend. If we have an uptrend, looking for a pullback to form a hammer, getting long above the high of that hammer with a 3 point initial stop. And if the candle is bigger than 3 points, that's okay. I just leave it at 3 points. If it's smaller than 3 points, I'll tighten it. If the candle was only 1.5 points, then I would use a 2 point stop. If, like we saw last week, a little bit of expansion in volatility, maybe the candle's 4 or 5 points, then I would just leave the stop at a max of 3 points. The nice thing about these trades is you're getting in the trade with momentum. If the hammer is your signal bar and the next candle is your entry bar, when you get that entry candle pushing through the high, pushing through your order, which is going to be, a buy stop on the long side, sell stop on the short side, it's punching through, and typically, you're in profit fairly quickly. you take a little bit of heat, and then as we're going to get to here next, we can start tightening our stop and reducing our risk as the trade goes on. So from a trailing stop perspective, what works really well is to trail swing highs and lows. So if we're long, keeping our stop below the swing low as it moves higher, pulls back, moves higher, pulls back. And if we're short, keeping it above a swing high as it moves down and bounces, down and bounces. That also works super, super well when you're swing trading on daily bars. And, you know, typically a swing trading approach, trending swing trading approach is going to work the best in a low volatility bull market. And so when you get these 6-month, 1 year, 2 year tight uptrends, you can be trailing swings and staying in some of these stocks for sometimes months at a time. And it really, really works well to trail swings in that manner. So you can do it one of two ways. So I've got a little diagram here. If we're looking at this uptrend, we have the swing high identified, where I have initial stop below the low, that would be a swing low. And then we come up here and make a higher high at the swing high. And then we pull back. You can either wait to move your stop when we break the pullback candles high, or when we break the swing high. Either of those are okay. Moving it when you break the pullback high is going to be a tighter stop versus waiting for the swing high to break. That's going to give you a little more time with your stop a little bit further away. But those are kind of just two subtleties that are worth paying attention to. So when it comes to specifically day trading the ES on the 1 minute chart, we can look at trailing each bar as well. So what I like to do is start by trailing. I start with that 3-point stop, and then I will trail the next swing high if I'm short. And if we get 3 consecutive red bars that make a new low, then another new low, then another new low, then I will switch to trailing each candle from that 3rd bar on. And that way, if I get into a trade and we very quickly start nosediving off a cliff, I'm not leaving my stop way away from where price is. Now I have that 6-point target out there to catch me if we just sell off immediately and hit that 6 points. But at the same time, I want to be bringing my stop in. You can also move your stop once the trade is 3 points in your favor. You can move it to break even. And most platforms, you can have it set up to automatically go to break even, which is quite handy. You don't have to be counting the prices, and just takes the, anything to take off the movement of you having to move prices on the trade ladder is very helpful. The thing is, you just want to trade the same way every single trade. You could also just trail each bar out the gate, and as soon as the 2nd bar closes, you move your stop above that candle. As soon as the 3rd bar closes, you move your stop above that candle. And you don't even have a target, and you just keep trailing bar after bar after bar. Some trades might go 2 or 3 bars in your favor. Some might go 10 or 12, and you might end up with a 15 or 20 point winner just on trailing each candle. But the thing is, you want to be consistent in your execution. Otherwise, if you're bouncing back and forth, you're going to miss some of those big winners that will help offset the losers. So kind of the sweet spot I found, 3-point stop, 6-point target, start by trailing swings, and then if you get 3 bars in a row that are red, 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 and you're short, you can come in and tighten, and so your stop isn't super far away. So a couple of examples of the kind of the best places to take some of these trades. If you use a 21 exponential moving average or a halfway back, you can look, this is an example from the other day where the market was trending down. You don't really have to have the 21 on there to identify that if you just look at swing high, swing low, lower high, lower low, lower high, lower low. So you can easily identify the trend just by spotting those swing highs and swing lows. The 21 is just a helpful visual. And then some of you might be looking at kind of 50% retracements. When the market pulls back to the 21 in a downtrend, that's a great place to take a short. So on this one, I just shorted underneath the inverted hammer, and that was where that 3-bar screenshot on the last slide was from. And came down, got it 6 points, and then I'm getting out of the trade, locking in profit, and then looking for the next bounce to the 21 and in trend. So taking trades in trend are going to be the most likely to be profitable and most likely to get momentum. Here's another example of a halfway back to the long side. And you draw up your 50% retracement, pulls back, touches the 50%, and then you're getting long above that high, the low bar. 3-point stop goes out, 6-point target, and just kind of trail it as you're working your way to the target. Now, a counter trend situation might be like this, a double top. So I always like to mark the 30-minute high and low. So at 10 o'clock Eastern, I put a line at the 30-minute high and 30-minute low. And you'll find that on trending days, we break out of that 30-minute range and we don't look back. And on range-bound days, like Tuesday was an example, we just stayed within the 30-minute range. And when you're range-bound like that, you do not want to be placing trades in the middle of the range. You want to be shorting at highs, buying at lows. So that 30-minute range kind of parameter or identification is a really helpful way to kind of put some physical lines out there. I don't do a whole lot of horizontal lines on my chart. I like to keep the chart pretty clean, but those are 2 lines that I find very helpful. Today, on the other hand, we kind of started out in a very tight triangle at the open, and then we've dropped since. And if you mark that first 30-minute range, we've moved down and we kind of haven't looked back. So if you get a double top and you're up at a resistance point, could be the prior day's close. In this case, it's the 30-minute high. Looking for a short at highs is a great opportunity to take a counter trend trade, or looking for a long at lows. And what I mean by counter trend is the trend coming into your entry is up, but we're looking at this resistance point as a bigger reversal, and a double top is a very clearly identifiable potential reversal point. And so looking to short at highs on an inverted hammer with a double top at a resistance point, could be at a larger halfway back, could be at a pivot point, market profile, anything that kind of signals there could be resistance here. When you drill down to that 1-minute time frame and you get that inverted hammer, that's signaling that yes, there is resistance there. Price went up to that resistance point and was rejected. And those make for really good entries. The counter trend trades typically are the ones that run the most, but they have a little bit lower win percentage. For them, in general, buying a hammer down at the low of the day in the first 20, 30 minutes of the day, usually first 20 minutes, especially if we have a little bit of a gap down, market's been in an uptrend for the last year or longer, minus the tariff dip, but those hammer low buys early in the day oftentimes end up being the low of the day. And we have a little bit of a gap down, and then as soon as we kind of dip a little bit, it's bought up and we shoot to the moon. Let's see. So yeah, let's kind of tie everything together here in summary. And some of the main points are, with that entry in an uptrend, be looking for hammers. So a pullback to the 21 EMA is really, really helpful. It's clear, it's easy to spot. You don't want to have very much subjectivity in your thought process when you're trading, especially day trading. Swing trading, you can do your analysis after the market's closed, set your orders, and kind of walk away. But with day trading, you know, get your trading criteria down to a 3x5 note card or a post-it note, or screenshot your entry or 2 or 3 entries, maybe a long and a short entry, and have that in front of your computer. Review it in the morning. And also, side note, again, lots of side notes, have a little notepad where you write down mistakes you've made. And that way you can review that and keep those mistakes fresh in your mind so that you don't repeat the same mistakes over and over again. And so even if you're just reviewing it on Monday morning, not necessarily every day before you're trading, it's a really helpful way to kind of keep progressing and keep moving forward every single day and every single week. So hammers in uptrends at the 21 EMA, at a halfway back, at a double bottom, those are the 3 best places that you're going to find. You know, the halfway backs and the EMA kind of tie together. That's kind of one point, but those are going to be the most high probability entries. And then if you turn it upside down, an inverted hammer, short, actually short, not shot, is going to be at the 21, bouncing to the 21, and at that halfway back point, and then a double top would be to the downside. Stop is going to be 3 points, and target is 6 points. If you're using the NQ, can move very, very fast. I know it's enticing to want to trade the NQ or the YM because it's only a $5 per point instead of 1250 per tick, excuse me, 1250 on the ES. But that 1250 tick on the ES helps the market slow down and allows you to actually place trades on the trade ladder. Sometimes the NQ is moving so fast, you just can't even get an order in. So 3.6 works really well on the ES. If you want to use something, you know, around $150 and $300 on the NQ, you could go a little bit bigger, even 200 and 400 can work well. But again, if volatility is low, it can work well. But on the NQ, when volatility gets high, whereas the ES, you can, you know, keep trading. Even in higher volatility environments, the NQ can sometimes get so much whipsaw and so much slippage, it's just not even worth it. So I primarily stick to the ES. If volatility does jump and we're up in like VIX 25, 30, then if it stays that way, usually after a couple days, we kind of settle out. Like last week, volatility jumped, and then we came in a bit, a few days go by, and then we're right back to kind of similar trading that we had the week before that. But if volatility were to stay high, then you can double your stop, double your target, and cut your position size in half, and that will keep the same risk. So if you're trading 4 lots at a 3-point stop and you cut it down to 2 lots, but you have a 6-point stop, then your risk is the same. But you just have to double your target as well. Higher volatility is going to, you know, allow a larger profit target to get hit sooner, but you need that wider stop. So that's something you can do as kind of an adjustment if we go into a, you know, a longer term downtrend or bear market or something like that. But typically if we get a bigger sell-off like we had last Friday, 2 Fridays ago, then you want to kind of just pause for a day or two and let the market kind of digest, because that's when you get a lot of whipsaw price action where you have a lot of what seem like technical setups, but there's just so much whipsaw back and forth that you can get chopped up and stopped out, even if it ends up going your direction. So I always like to kind of pause and slow things down as much as I can. Let's see. And then the last one, the exit, you can, I like to start by trailing. If I'm long, trailing the swing low. And then if we get those 3 bars in a row, so if I'm long, it needs to be 3 green bars that each candle makes a higher high over the prior candle. And that's indicating that, okay, we've had 3 minutes of new high, new high, new high. I don't want my stop to be, you know, 6, 7 points away from where price is. So that allows me to tighten it. Using that +3 move to break even works really well. Yeah, there's going to be some times where it comes back and stops you out, but as long as you use the same trade management approach every single time, then it averages out over the long run. And I even compared, you know, a couple different exit points or exit approaches. And, it's no surprise that over, a couple of years, even comparing my trades with, exiting a slightly different way, it comes within like a point or two of being the exact same. So as long as you stick with what's working, you don't want to be jumping from, one strategy to another strategy. That one stops working for a week or seems to not be giving you as many setups, and then you jumping back to another strategy. You want to stay the course, and that's why we kind of started with some of the bigger picture stuff that can help kind of set you up for success over the long run. So that's what I've got for you today. I got my email on the screen there. If you have questions, you can always send me an email if you think of something later, tim@EminiMind.com. Otherwise, you can reach me over at EminiMind as well. So thanks for allowing me to speak today, and I hope you found a couple of bits and nuggets in there, and I hope you have a great rest of your week.